Hello, everyone. This is Anthony Valeri, Director of Investment Management in the Wealth and Fiduciary Services Department. Thank you for joining today, May 7th. This webinar will talk about what shape the economic recovery will take. Will it be a V, U, W, or L? As we try to use letters to describe the potential shape of this economic recovery when looked upon on a graphic format. So we'll talk more about that, the implications for financial markets as we continue to keep you apprised of our latest thoughts during this period of market volatility amid the coronavirus. So let's go ahead and get started. We expect a U-shaped recovery. The U basically represents a pretty sharp drop followed by a gradual slowdown, a bottom, and then a sharp acceleration out of a recovery. You're going to have or continue to see a lot of debate about what that shape will be. The stock market, however, given the recent rebound, reflects more of a V-shaped recovery, but we think that's a little premature, and we'll talk more about that. And a key focus in the coming weeks will be global economies are reopening, states in the U.S. are reopening. The pace of improvement, the potential drag on corporate profits, along with the threat of a virus resurgence are all threats that may keep stocks range bound near term as we assess that pace of reopening along with the potential for a virus resurgence. So lots more to come as we progress on this recovery. But let's get into the shape of an economic recovery. And when you talk about these letters, this is a quick guide on how to look at that. In the upper left is a U-shaped recovery. So broadly, a U-shape, a quick fall, a quick deceleration, followed by some stabilization, and then ultimately some improvement. The big question is whether the bottom portion of that U is elongated or if it's a short U, but still, this is an example of how economic growth, as measured by GDP, could resume to normal, measured by the pre-corona baseline over time. On the top right, you'll see the V-shaped recovery, pretty self-explanatory. That is a sharp drop followed by a quick recovery. The W, and I'll have an example of this later, is more of a sharp drop, a recovery, and then a subsequent decline followed by ultimate recovery. And then the L-shaped on the bottom right is more of a depression scenario where the economy doesn't resume its normal pace of economic for a very long time. So those are your basic shapes on how the economic recovery historically has played out. And let's talk more about that. But first, take a look at some of the economic data. PMI data, which is Purchasing Managers Index data from around the globe, has been very weak, either matching or exceeding the lows of the 2008 financial crisis. This is the overall PMI from both developed markets and emerging market economies. This is comprised of both the service sector and factory sector, manufacturing. Manufacturing is generally held up better, and the real damage has come to the service sector, especially hospitality, travel industries. And if you look at the subcomponents to some of these country indexes, you'll see some of the weakest readings, in some cases weaker than 2008. So the data has been very, very weak and corroborates a sharp grinding to a halt of the global economy, much of which is well known. But just to show you how bad this has become on a graphical format, another way to look at that is to look at it relative to the degree to which economic data either surpasses or falls short of expectations. So the U.S. Economic Surprise Index is a way to measure that. A declining line means that economic data is much weaker than expected. Conversely, a rising line showing that data is stronger than forecasts. And what you're seeing now is that this line is essentially at its lowest point ever, or very close to that, actually meeting the weakest level seen since late 2008, early 2009. So economic data is about as bad as we've ever seen it, and it's really tough for the data to get much worse at this point. And when you're an investor, that partly fuels or explains the stock market's recovery. The stock market is anticipating a recovery, and part of that is because the low point in terms of economic data may already be here, especially with states and global economies beginning to reopen. Unemployment claims are showing one of the more better timely data indicators of real-time economic data. You can see the sharp increase in weekly jobless claims reaching almost 7 million at one point, but jobless claims have been trending lower, and this is your first tangible sign of improvement. Still, nonetheless, this is bad news. So the good news, it's slowing. Bad news, it's still very high on an absolute basis. Earlier today, the jobless claims for the week ending May 1st came in at 3.1 million, so slightly ahead of forecast. Over 33 million people have lost their jobs. So that is a very stark and stunning data point. Tomorrow, Friday, will be the monthly jobs report, which will reflect an unemployment rate, or expected to show an unemployment rate of 16% and 22 million total job losses. So this is one we'll continue to watch, but it is showing improvement, heading in the right direction. And again, markets move in anticipation of that. So the data is getting worse. Looks like the low point is certainly in April, and you're starting to see that on other data points. This is the ECRI weekly leading economic index, and we often turn to more timely measures of economic data to get an indication of whether data is improving. Here you can see the bounce off of the lows in April, again falling to a level like some of the other data points we followed to early 2009, and then bouncing higher from there. So some initial signs of a rebound, and we're seeing it in other alternative measures as well as we look for signs of how the economy is coming out of this. You look at gasoline, finished gasoline, that supply has increased as well. It's a sign people are getting back on the road. So here also an improvement of gasoline usage going forward. So some incipient signs again of improvement in the economy. And when you look at the number of states, here's a map to show how states have either have started to reduce restrictions. The gold represents lifting of restrictions in those particular states, or that they never had major restrictions. Texas and Georgia have probably been most prevalent in the media for beginning to ease lockdowns. Georgia's been open for about 10 days now, and Texas will be about a week by the end of this week. So we're going to watch those states closely to see for any potential resurgence, but states have gradually begun to reopen. That is a positive sign. You can see the number of states have yet to ease restrictions, but have talked about it. So we'll be watching this closely in coming weeks to gauge just how much activity picks up off of that bottom. Another way to measure progress on easing restrictions is the University of Oxford has come up with a government stringency index, and this is for a number of countries, for all countries across the globe. The dark blue line is China. You can see how they've gradually eased with a slight uptick lately as some cases resurged. Germany has flattened out, but that country too has also eased restrictions starting last week. The green line is the US, and it's been coming down a little as of late, just showing that some states have begun to ease restrictions. So we can use these measures to gauge real-time activity on how restrictions are coming down, and therefore sending the signal for a potential improvement in economic growth. Another measures to look at it, TSA total travelers at airports. This bottomed also in April and showing some initial signs of improvement as people begin to travel. Long way to go here, though. This is very early improvement. Overall travelers down almost 90% year over year. So still a long way to go to get back to normal in terms of airport traffic, but starting to see some signs of economic activity picking up in terms of travel. And then some alternative signs of data have also popped up as well and become very useful. So the amount of people using Apple and their cell phones to find or create driving routes, get directions is increasing. That's one way that both Google and Apple are providing real-time data in the rebound from the coronavirus. And you're starting to see that in Georgia, which is one of the first U.S. states to open. You can see the U.S. average in general, and then New York as it's slowly beginning to ease restrictions as well. So again, you can see the bottom in middle of April roughly, and then some slow improvement since then. So these are some of the kind of alternative data points that we're going to be watching to gauge improvement in the economy going forward. It's good to see a start, but we'll continue to evaluate. Similarly, if you look at traffic congestion relative to the start of 2020, and this is taking a more global look, this data isn't just confined to the US, you're seeing that congestion is still below normal, but starting to trend closer to a baseline. And you're seeing that across a variety of countries, US, Germany, even Italy, hard-hit Italy is starting to see an improvement as May 4th announced, or was the start of some easing of restrictions in Italy, and you're seeing some traffic congestion slowly head back to normal levels. So a number of alternative data points we are going to be watching to see how the economies globally get back to normal and how quickly they do so. So we're starting to see some signs, again, a good thing. However, there are some segments of the economy that are not improving. If you look at open table reservation data, and this is another one of those alternative data points to track the strength of any reopening. There are segments of the economy that are still essentially shut down. The restaurant industry is one of those. There are some states, however, that are not down 100%. They've actually been down 96, 95% for those that are starting to open. So some very initial signs that this is easing, but for the most part, this is going to take a very long time to improve. And so you're going to see segments of the economy that take longer to improve. Obviously, the restaurant industry, one of those. And even partial reopenings may not be as profitable for some restaurants that choose to focus on takeout. So keeping an eye out on this one. This will truly be a sign that things are improving when we get this restaurant index back to normal, but this one will take some time. So there's still very much weak parts of the economy. What does that mean for the stock market? Well, we've seen a bounce back in the broader market. This is the S&P 500 index, a broad measure of the U.S. stock market. You can see the sharp fall and then the subsequent spike higher. This is essentially a V shape in terms of recovery. There are two red dashed lines there, though, however, and that shows that the market's been a little bit range bound here over the past couple weeks, right around that 2,800 level, which interestingly enough corresponds to about the 50% level retracement from the March 23 lows, and that historically has been a level that has created some congestion, some consolidation as the market begins to assess, takes out the worst case scenario. In this case, a big part of the eliminating that worst case scenario is the really robust response from the Federal Reserve and the government in terms of stimulus. But now it's really about assessing what is the strength in this opening, how long does it happen, and is there a virus resurgence that would create a bringing back of restrictions. So I think a period of consolidation is ahead in the market. We think the market may have actually gotten a little ahead of itself, just given the lingering uncertainty to not only the economy, but corporate profits. So we think we're in for a long, tough fight here as an investor. It's going to be a challenging environment over the rest of the year, even though the lows may have already been put in place. And the reason we say that is that corporate profits, which in our view are the key driver of stock prices over the longer term, continue to weaken. First quarter earnings season is just over halfway complete. Earnings are tracking to about down 15% year over year. Full year consensus earnings growth, however, continues to get ratcheted lower. And I think that's probably the right expectation. It'll probably go down to around a down 20, down 25%, which is probably about right. But as the uncertainty around corporate profits is, it needs to stabilize and we need to get some sort of clarity, which I think it's too early for that. And again, that will be needed to really provide a better fundamental foundation for stocks going forward, especially with earnings growth so weak, forecasts coming down. It's hard to have a lasting improvement until there's better clarity on corporate profits. And another way to look at that is to use those profit numbers and a simple PE ratio to gauge what is fair value for the S&P 500. And on the top part of this table, if you assume that earnings are going to drop 5, 10, 15, 20, or 25%, what is the right price for the index for a given PE ratio? I've highlighted some in yellow there as to what I think is sort of a plausible scenario if earnings drop between 15 and 25%, and then the PE ratio is between 17 and 19, which is roughly an average PE ratio. And if profits stay at down 15% and the PE ratio is 19, then that equates to 2632 on the S&P 500. I think if profits stay in that minus 15 to minus 20%, then fair value is really about 22 to 2600 on the S&P, which is below the current level. And that's a sign the market may have gotten ahead of itself during this rebound. So a little cautious here short term because of that. I should caution that that the stock market doesn't value itself on a single year's worth of earnings, and to some degree, investors are writing off 2020. Really, as an investor, you're looking at about 5 years worth of earnings, but I still think the expectation that a rebound to corporate profits will happen quickly is a little misguided. So we do need, I think, better signs from the economy and corporate profits to sustain a meaningful move higher in stocks. Over the near term, however, there is still a lot of pessimism into investing. You can measure that one way by seeing which way speculators are betting on the market. And recently, there's a big net short, meaning there's lots of speculative bets for stocks to go down. Historically, this has been a contrarian indicator and one that provides near-term support for stocks. So if you look back and you see that net short establishment, that tends to provide a bit of a floor for the stock market. And over the near term, I think this is support for the market. So wouldn't be surprised to see some modest improvement even now for stocks. Again, I'd use this more as a short-term indicator only. It's ultimately going to be the economic fundamentals and corporate profits to drive it long term. But this short base is contrarian and may continue to provide some near-term support for stocks. But longer term, this may fade, but again, over the short term, this is providing some support for stocks. So as we look out longer term, what are the risks? And this is one of the key risks with stocks as the economies reopen globally. First, although economies are reopening, the number of cases reported, new cases reported in the U.S. is still very high. So the growth rate has slowed dramatically in the U.S. New case growth is around 2 to 3% and has been for about 2 weeks now. And you can see that represented on this chart, but the absolute number of cases is still elevated at just over 20,000 per day. So that's likely to come down. But relative to Europe and certainly China, we have not seen the sharp deceleration or a quicker deceleration that would remove that risk of a resurgence. So something to watch as cases remain elevated in the US and states begin to reopen. Getting back to the shape of a recession, this is Europe following during the financial crisis and following the 4-quarter moving average is that orange line. And you can see if you follow that orange line, it makes sort of a rough W shape. This is known as the double dip recession. So you have a recession, a recovery, and then a return to recession. In Europe, following the financial crisis of 2008, there was improvement. And then all of the government austerity measures, the tightening of spending that ultimately fueled the concerns over the European debt problem, which is really what drove this. European debt problem concerns sparked another recession, albeit a mild one, in 2011 and 12. And you ultimately had that sort of W shape in Europe. We could have a little bit of a W in the US if there is a resurgence in the fall and winter, but that would be over a very, very short time frame. So I'm not sure if that would translate to sort of a W, but that would be the closest I think this recession leads to sort of a W shape. And if we look back at other economic expansions, this chart shows the strength of economic expansions following a recession. And really, most recoveries are U-shaped. They tend to be rather dramatic at first, gradual but subtle improvement, and then it accelerates from there. The only case of a real V-shape, or it's rare, is that orange line in late 1957. And if you look at also the early 60s, a purple line, another V-type shape recovery. Of course, the light blue line is the post-2008 recovery, which was very gradual and slow compared to historical norms. So sort of a elongated V or W that kind of had its own unique shape. But most recoveries are U-shaped, so it's important to keep that in mind. And again, the real question here is how much or how long is that bottom of the U in the current case? We still expect an acceleration late this year, early next. Ultimately, once a vaccine is developed, we should see a pretty sharp acceleration in economic growth. And there is a lot of progress on medical treatments here. There is a antiviral drug, remdesivir, which has shown effectiveness. The FDA has also approved 12 antibody testing drugs, and you're starting to see states hire people to do contact tracing. All of those are going to help, one, help treat the virus, and then two, isolate any new infections as they arise. So the the speed at which we're coming up with medical treatments is something to behold, and a vaccine could be as early as late 2020, but that seems aggressive. Ultimately, we think a return of a vaccine, which at the later end would be maybe a year from now, really would spark a strong economic response. Talked about the resurgence next fall or winter could lead to a W recovery. But again, we think some of the medical treatments would limit that impact. We don't expect a depression, which would be an L-shaped recovery. And the big important reason is the strength of the response, both from the Federal Reserve and the U.S. government in terms of stimulus. Both have been far more aggressive now compared to 2008. Keep in mind, during the Great Depression, the government response was poor. The Fed raised rates, the government tightened regulations. There was a bit of a trade fight as well. So a number of policy missteps really caused the Great Depression to be worse than it should have been. And I think policymakers have certainly learned from that and seen the exact opposite here in 2020. Again, to conclude, stock market has made a V shape, but we think the rebound may stall just due to lingering uncertainties over how much do corporate profits fall, when do they improve. I think it's going to take more than a year, maybe more than 2 years to get back to normal on the profit front, which limit the upside. And then again, big questions on the success of reopening economies and the threat of a virus resurgence. Everything's moving in the right direction, but I think the market's priced in a lot of that improvement. So near term, expect some consolidation. Over the longer term, we remain optimistic as investors. We think stocks tracking to about 6 to 8% longer term, but it's going to be a challenge, we think, over the remainder of 2020. So be patient. And continue to stay focused on your investment opportunities, rebalancing portfolios when necessary, so you remain on track to your financial goals. Thank you again for listening. Look forward to keeping you up to date with further webinars in the future as we continue to navigate this challenging environment. Thank you again. I'm Anthony Valeri, Director of Investment Management.